Saurabh Mukherjea joining us. Let's get his take. Saurabh, good morning. It's good to be in conversation, at least when it seems like perhaps the trend might be turning. I don't know if it's too soon to tell, but we have midcaps cheering. Right. We've got finally a buy figure coming in on the FI front. Where do you feel we're poised at this juncture? Do you see a shift in trend, or is it still too soon to tell?
I think from a macro perspective, from an economy perspective, I think the bottoming out probably will be the second quarter. I think the quarter to September will probably be the worst quarter of economic growth. But from a market bottom perspective, I don't think we are that far away. I've been saying for the last couple of years, markets are overvalued. I think a substantial portion of that overvaluation has been taken off. There's a little bit left. But what I think should give us lots of cheer is steel prices are coming off, rubber prices are coming off, the currency is weakening, banks' cost of funding is coming off. All of that suggests that somewhere in the next 6 months, the economy will bottom out. Typically, stock markets bottom out before the economy bottoms out. So it could well be that we are closer to the bottom of the stock market, even though GDP growth could come off for 1 or 2 quarters more. So this is as good a time as any to think about building high quality, top quality Indian portfolios and benefiting over the next 4 or 5 years, rather than buying into all the doom and gloom that's being sold, I think daily in our newspapers and broker notes.
Saurabh, when you say that this will be the worst quarter for economy, what are the factors which you're considering? Because my follow-up question would be that how can be one sure that the pain will not get prolonged? Because the word animal spirit is missing, the word euphoria is missing, the word leverage is missing, the desire to create, the desire to spend by corporates is not there, and the desire to spend by consumers has taken a backseat.
So I think good point. I mean, it's always difficult to call the bottom of the economy or the bottom of the stock market. I think what suggests to me that the second quarter to September, growth will be worse than the quarter to June is most companies I've spoken to have said that August was a washout both in the senses of heavy monsoon and washout from a weak demand perspective. Just as you said, Nikunj, demand has been really weak through August. Now, what gives me the confidence that the quarter to December will be better and second half of the year growth will be better than first half? I think firstly, if you look back at the previous financial year, the economy was actually in pretty decent shape this time of the year. So even H2, even Q2 last year, we had a pretty punchy growth. I remember auto numbers were pretty healthy till even in second quarter of the year. It's around November, December that the economy started losing steam last year. And I reckon from a base effects perspective, we will see H2 numbers perking up vis-a-vis H1 as the steam started ebbing out of the economy over the last 6 months, and therefore second half of the year we should see favorable base effects. Secondly, as I was saying, the conking off in the cost of raw materials is actually is pretty punchy. You think we're down 15 to 20% on steel and rubber. So if you think of, say, the auto industry's perspective, by Christmas it could well be that the cost of putting a car in a showroom for an auto OEM in India could be down by as much as 15-20% comfortably. If over and above that cost of money comes off, the banks start cutting rates. I know the banks are not yet cutting rates in a punchy manner, but I don't think that's very far away. I think the RBI too will cut rates at a fairly fast clip over the next 12 months. If rates start coming off, and over and above that the currency moves towards mid-70s to the dollar over the next 6 months, I think we've got multiple engines firing to perk the economy up. I don't think we should expect a blazing economic recovery in the second half of the year. It ain't gonna happen. But I think the YOY growth prints, there's a good chance that the quarter to December, the YOY growth prints will start perking up a little bit. And early next year, early next fiscal, we will see the first signs of a tangible recovery. I think that's the mental setup I'm working with. It does look clear though that August was a washout on all accounts, on all fronts for the Indian economy.
Don't expect a V-shaped recovery. Can I say that we are in for very moderate gains? I mean, late single digit or maybe early teens, that's what you should expect from the market in next 12 to 18 months. The good thing is that at least we are hopeful of getting positive returns, unlike last 1 year where returns have not been there. But yeah, returns will not be grand or gala in nature?
So let's just cover off the economy first. To be fair, we've had 2 to 3 quarters of economic deceleration. So from that, for us to get a V-shaped recovery will be a bit of an economic miracle. To the extent that the economic deceleration looks likely to sort of bottom out in the middle of this year, I think it's fair to expect a more gentle recovery towards the beginning of next year rather than a V-shaped recovery. From a stock market perspective, if you look at the market, there are so many juicy companies now, especially in small and mid caps. High quality franchises, smaller franchises, where valuations have come off so considerably over the last couple of years that one can't but feel that at the first signs of a gentle recovery, we will start seeing a degree of appreciation on those share prices. So difficult to call the market bottom. I'm not so sure the market has bottomed out just yet, but it is looking decidedly good time for going bargain hunting in India. Even though there is a degree of risk out there. One should always realize that bargains are only available when there's a degree of risk out there. It does feel a little difficult from an economic perspective, but my reading of investing has been that that's exactly when you should go bargain hunting, where you still feel a little bit of risk in the air.
And where do you think such a proposition lies within the broader market, Saurabh?
So I think we've discussed this sector before on your channel, but no harm in discussing it again. I think auto is a sector where one needs to look quite carefully to the extent that there is a EV versus internal combustion engine disruption that none of us can do much about. If we focus on those aspects of the auto ancillary sector, where even if EV gains traction over the next 5-6 years, those elements of auto ancillary will be in demand. There are whole swathes of the auto ancillary sector where valuations of prices have come off 50, 60, 70%. That's where we're doing some bargain hunting. I wouldn't like to disclose names just yet. Give me a little bit more time to do some more work before I come back to you with names. But I do believe that in auto ancillaries, there are high quality ancillaries, super balance sheets, dominant positions in that specific car part or motorbike part where valuations have come off 60, 70%, and I think it's worth looking at those. I would even say even in trucks where CV demand seems to be sort of falling every month, I think it's worth having a look at the CV manufacturers in our country. There's only 3 of them really that are relevant. Again, I'm doing some more work to figure out which CV manufacturer we should be looking at more carefully, but I think there is upside both in CVs and in auto ancs. The other area is pharma. It's been an unfashionable sector for a long time. Divi's is the main stock that we've held in several of our clients' portfolios, but I think we're getting to that juncture where I think there might be other stocks in the pharma sector that we would like to also look at. So if you had to look at 2 sectors with strong balance sheets, proven record of generating cash flow and shareholder value, I think auto and pharma are right there staring at all of us. And I think we're probably we're getting to a stage where there's a sheer sort of tastiness of the bargains on offer might prove too tempting for at least investors like me to resist beyond a certain point.
Immediate follow-up question, Saurabh, is that auto ancillaries have corrected, valuations attractive, but this entire overhang which investors now will have permanently on their mind of this EV. Now, I think EV is not going to come, at least in India. It will be later than sooner. But this overhang the sector will suffer with will cap the P expansion. P expansion will always happen when there is a freewheeling kind of an environment. And unfortunately, there is a cog in the wheel there. It could be psychological, but the cog in the wheel is there.
So agree with you. So look, I think what will happen is the auto sector and auto ancillaries, I think, will bifurcate. There'll be stocks in the sector, say for example, crankshaft manufacturers, chassis manufacturers, stocks in the sector which will suffer from the EV overhang, as you nicely put it. And then there'll be stocks where, say, side mirrors, windows, the plastic paneling which goes inside a car. There'll be stocks where the EV overhang is irrelevant, because even if we switch from ICE to EV, you'll need those parts of the car. So I think we're heading for a bifurcation in the auto sector between elements of the sector which face some degree of questioning of their growth rates as EV becomes into vogue, and other parts of the sector where, regardless of EV, demand will remain relatively robust. So we're probably going to end up with two auto sectors: EV affected and EV unaffected.
Saurabh, since you're still, seeing a little bit more time before we manage to see this kind of recovery coming in, where do you see the bulk of the pain still to come? Which are the pockets where you still feel we're going to, see the most pressure when it comes to earnings, when it comes to delays, financial pain? What would you really either stay away from or just, bide some time till some of those issues get resolved?
I think the main concern remains our lending sector, our financial services sector. So if you ask bankers why aren't they passing on the RBI's rate cuts, effectively between the lines what they're saying is they expect more pain on NPAs. The auto sector NPAs, there are plenty of car dealerships which have borrowed money, which probably going to struggle to repay those monies. There are plenty of auto ancillaries who might have a degree of pain. The auto ancillary ecosystem is so vast in our country, there's bound to be some degree of pain there. Obviously, real estate developers, promoters who have borrowed money struggling to repay. So if you talk to the lending sector, there's still a great deal of jitteriness about NPA development certainly in the quarter to September, perhaps even thereafter. So that then begs the question as to can our NBFCs, can our housing finance companies, can our private sector banks get out of this funk that they find themselves in? Now, we've discussed this before on your channel. From an investment perspective, it's easy for me to say we hold HDFC Bank and Kotak Bank, and I also own these stocks personally. But from a sectoral perspective, when will our bankers and our lenders get the confidence that the NPA cycle is behind them and they can take a bit more risk? I think that remains the big unanswered question. I'm not getting to meet too many lenders. I haven't met too many lenders in the last 6 weeks or so who have any confidence that the NPA cycle has bottomed out, and that remains a source of concern for all of us.
So, Saurabh, I just remember, and I always appreciate some of the classic compounders what you have. Abbott is one classic compounders, you have it from last 2 years. Is the classic compounder now reaching a level at which you would say, look, I am an investor, I buy gold at the price of silver, but when gold starts trading at the price of diamond, I need to get out. Abbott is gold, but is that disproportionately priced because the stock I saw on my screen yesterday was at an all-time high?
So the way to think about these stocks, what I've been able to do over the last several years is realize that in an economic boom, they'll compound earnings at 25-30%, and in difficult times like the ones we're living through, these sorts of stocks compound earnings at 15 to 20%. So even I think in the quarter to June, our consistent compounder portfolio, which is made up of stocks like Abbott, and thanks for reminding all of us about that. In the quarter to June, our earnings growth in our portfolio was 17%. So difficult times, portfolio chugs out good returns. If 2 to 3 years out, we're in a raging economic boom, I reckon earnings growth will be 25 to 30. It's not going to go beyond that. So these portfolios give you good absolute returns, bull market or bear market. But I think what you are highlighting, and correctly so, is in a raging bull run where if the market's running by 30-40%, a consistent compounder portfolio could underperform. So even in a raging bull run, this portfolio will probably give around 20-25% rather than 30-40%. It'll underperform in a raging bull run, but in the circumstances we find ourselves, it's obviously outperforming at an astonishing rate. I think in the last 10 months, we've outperformed the market by 10-11%. Cross cycle, you end up with 20%. And if you end up with 20% in India, cross cycle, I'll happily take it, and I think so will most of our clients. I think that's what we have tried to inculcate in our client base, the willingness to play the long game, a realization that yes, in a bull run, an Abbott could underperform, but in 3 out of 4 years, Abbott will give you better returns than the market, and pretty consistently will gun out 20% returns. That, I think, for people like me and most of our clients, I think is a good outcome, and hence we'll patiently stay wedded to the Abbotts, the HDFC banks and the Kotak banks of the world. And these are both personal holdings and client holdings. It's the willingness to play the long game rather than trying to call every turn of the cycle.
Saurabh, given that we are starting to see that pick up across mid-caps, anything new that's catching your eye, any new trend? I know you mentioned ancillaries earlier, but just throwing it out there, like, would you at least be in wait and watch mode if we do start to see that momentum on a sustainable basis across the broader markets?
I think what we're trying to do is, we all see the macro numbers. We're trying to see if the financials of, say, the auto companies have cracked decisively. So if you see Maruti, Maruti's operating margins has cracked considerably in the last 6, 7, 8 months. Right, so it's not just volume conk-off for Maruti. The margins have cracked decisively, which is actually, from an investor's perspective, quite a good outcome, because that way you're getting earnings getting plastered, earnings getting hammered alongside the share price coming off. But say something like Ashok Leyland, the margin crack hasn't yet happened big time, right? It's obviously a dominant player in CVs in South India, powerhouse franchise there, but the margin crack hasn't happened, even though volumes have come off so aggressively in trucks. So that's, I think, something worth looking out for. If you can get a class franchise where volumes have come off and margins are coming off, that's when you can start thinking about buying a class franchise. So when I was in my erstwhile job in Ambit, I remember 4 years ago, 2014, 2013, we put a buy on Ashok Leyland when it was at 30 rupees or so, and that's how we thought it through. We said volumes have weakened, margins have come off. Margins, I think, were non-existent. It was a loss-making company, and at 30 rupees, I remember, not even 30, sorry, 15 rupees, I remember we put a buy on Ashok Leyland, and it went all the way up to, I think, 150, 160. It's down to 60, 70. So that's the dynamic I've found useful in my previous bear market experiences. Watch for volume conk off, then watch for the margin conk off. When both have conked off, start thinking of buying powerhouse franchises, which will do well on a cross-cycle basis.